went to help a friend, Bob Carr, with his outdated website. Ended up staying around for a long time, and fast forward to today, Bob and I are partners in Link SV, which is business and funding intelligence on Silicon Valley and Northern California startups. And that informs a lot of what we're doing tonight. We launched a newsletter in 2020, also the Valley. So weekdays, we send out a newsletter that has all of the new fundings, exits, IPOs, M&A, and then on the other side, the VCs. Who's starting new funds, who's closing existing funds, who's going off and starting a new VC firm.
That's great data.
Thank you so much.
Fantastic. And I know I introduced myself as the host of 10X Growth Strategies. Besides that, I'm also a fractional CMO. I work with startups and venture funds on their go-to-market strategy. My background, I had the opportunity to be part of 2 IPOs. One is Nutanix and another was Freshworks, and several other startups as the marketing leader. So with that, I'd like to start off about this report. Tell us, what was your goal in producing such a report for 2025 venture market?
Well, the ideas for this report started when John Gregory, who's with Five Star Bank, and Bob and I got together and started thinking about what would be a good output for the startup ecosystem. And that's actually the whole realm. It's the startups, it's the people around the startups, and it's the VCs and the people around the VCs. And the venture market report is really intended to lay out the movement of capital in the Silicon Valley, which really now has grown beyond the Silicon Valley. We say Northern California, and that's what we cover, and it happens to be also what Five Star covers.
Yeah, no, that's great. I think it's great that they had the foresight to actually sponsor such a report with Five Star Bank. While we are getting started, was there anything surprising that you found while doing this report?
There were actually 2 things that stood out to me. Day to day, gathering the information, reviewing it, because everything we put into the newsletter gets curated. Hadn't realized how many new VC funds were started in Q1. And on the flip side of that, when we did the Q3 report, amazed how much M&A went through in that quarter.
Wow, that's great. Well, I'm going to jump right in with the first one, which is the funding report. Certainly it looks like good news, isn't that? We're now back to probably beyond the 2021. So tell us, what is driving this rebound? Tell us your inputs here.
It's amazing. Amazing to see us back and beyond where we were in 2021. Driving it, AI is at the bottom of everything. But that gets compounded with, I think, more certainty this year than there have been previous years about where the economy is, where we're going. Tariffs may have slowed things up in the first quarter, too. Now everyone's pretty much accepted we are where we are. And AI infrastructure and applied AI are really powering this return, and we're seeing it not so much the number of deals, the size of deals. We're seeing more mega deals, $100 million to a single company in a single round than really since 2021.
Yeah, I know, that's phenomenal. We've been hearing such funding going on. Tell us, which are some companies that are benefiting from such funding?
Any AI company doing frontier models has gotten a lot of money. And applied AI, as a matter of fact, just today, Harvey, legal, 160 million, Series F, 4th round this year. I haven't seen that kind of funding since 2021.
Well, that should certainly create more jobs, hopefully. That would be good to have.
Maybe different jobs, but yes, more jobs.
Right? Yeah. Now, want to deep dive into the funding by sector. Tell us a little bit about this chart and where is the funding going and what are underfunded, overfunded.
Yeah, the big blue is AI infrastructure, and looking at AI infrastructure that is hardware, that is software, that's everything that is pure play AI. And by pure play, I just mean it is not a vertical, it's not a horizontal enterprise. That all goes into applied AI, which is the second biggest slice up there. If you look at that big slice, we're looking at around 66% of the funding going to AI infrastructure. Add on the applied AI, which again is your enterprise AI, your horizontal, some of your verticals, and we're up to 75%, which is not that surprising. US-wide, 64% of funding is going into AI. So we get more here simply because some of the OpenAI, the Anthropic, these big companies that are getting 10 billion, 13 billion, 40 billion and around, they're here. So that boosts our percentage up higher.
Yeah, absolutely. In terms of how many founders in this audience? Show of hands. So looks like at least half of them are founders. So tell us your inputs on, based on this, what are some ways that they can actually approach the whole funding landscape?
It's tough for any company that's not doing AI or AI related, bottom line. And you better not be AI washing and just having a little bit in there. You gotta really have an edge, a moat around what you're doing and how you're implementing AI. And remember, we're only at the beginning of this. We really have not seen what's going to come from AI. And the VCs know that. So they're for sure looking for, okay, if I give you money now, can you protect what you have? Can you grow? Can you make sure that somebody doesn't walk in tomorrow and wipe you out?
No, absolutely. That's one thing, even when advising startups, that's what I've been talking about that. Because I think AI infrastructure, like you said, has a good place and many people know the value, but the rest of it, you have to make sure it's value driven.
Yep.
Absolutely. Let's take a look. You did mention some of the big numbers in terms of how much deal size, the median. I appreciate that you're doing the median deal size here. So tell us what is driving this increase. You mentioned it briefly, and is it a FOMO that we are seeing here?
Well, the large deal sizes are obviously driving the increased overall deal size, but it's also that the AI companies need more money. The frontier model companies, anyone who's doing anything in a foundation model is generally going to need more money than their equivalent not doing something in AI. So that drives it. Higher valuations drive higher deal sizes. And the number of deals is down slightly, so the VCs are choosing to put more money into less companies.
Well, let's take a look at some of the valuation.
Yes. Let me just, one other thing here. There is a divergence here because there was just under 25% of the rounds that went out flat, down, or bridge rounds. And what that reflects is companies that haven't made the cut to get to the next level. It's harder to get a Series A if you're a seed right now. You gotta have more in the way of revenue, customers, traction. And those bridge rounds are companies that just haven't made it to the next level, but their founder or their investors think that there's enough there that they're willing to give them a little bit more money to get to the next level.
Yeah, I think our co-host here, DJ Deep, mentioned that too, like 10-10-10 model.
Mm-hmm.
I'm sure he'll tell that much better than I do, but like 10 people, 10 months, and $10 million in revenue. So, that's the name of the game.
New bars.
Exactly. So anything else on this slide?
I think we covered that
Yeah.
on there.
Okay, let's go to the next one. There you go. Yeah, tell us about this.
Well, this is the next side, right? This is the money coming back in exits and hopefully then making our virtuous cycle in the valley, which is money comes back in, it gets invested back into funds, entrepreneurs start new companies, and we've been really low on exits for 3 years. As a matter of fact, you take 22 to 24, total value of those exits is about equal to a single year, 2021. This year, we're getting back to it. Through Q3, we about equaled most of 2021.
Yeah.
So it's a new high. A lot of it is coming, surprisingly, through M&A. It's always been the IPOs that drove things, but we have big acquisitions in 2025.
And what drove that? Like the M&A?
Well, you've got multiple things driving it. One is people have settled down in the economy. There's not so much uncertainty. The companies are willing to make some decisions and lay down some money, basically. So strategic acquirers have moved forward. Second thing is there's more companies that have made some serious product inroads, AI-driven, obviously. And now the build versus buy, move away from the build, okay, we'll buy. And the third thing is that there's some companies that are hitting walls. They've gotten no funding, they can't get new funding, they can't get a bridge round, so now do you liquidate or do you get acquired?
Yeah.
So those are the three things driving it, I think.
No, I think certainly we need that liquidity in the market.
Absolutely do. This lack of liquidity has just really slowed things up in the valley for the last 3 years.
Mm-hmm. Yeah, and with that, actually, did I miss a slide? No, I did not. Oh yeah, the valuation. Yes, yeah. So tell us more about like how are the valuations rising, and a little bit on the different rounds here.
Well, valuations have definitely continued to climb, and AI is driving a lot of this. There's late stage, new high, 839 million plus. It's up over 2024. It's not holding. As far as what's driving it, in addition to AI, is the large rounds drive larger valuations. The VCs want to get a certain percentage of companies. They may have to pony up more money at certain valuations. So this is sort of interconnected here. And it's not stopping anytime soon, I'm afraid. I saw a note this afternoon that Anthropic is now looking at raising a new round. They closed 13 billion in October. They're looking at raising a new round. October was 153 billion valuation. They're now looking for a 300 billion valuation. And this is pretty much, you've seen OpenAI, we've seen the other AI companies. Maybe not the absolute numbers, but the progression is pretty standard right now.
And I saw an article right this afternoon, Anthropic, that they're targeting an IPO. I wasn't sure if that's fake news or real news.
No, I saw that too. They are targeting an IPO. The question is, are they targeting an IPO because they want to do an IPO or because they want to be OpenAI to an IPO? Because OpenAI about a month ago did some fundraising and, we'll be doing an IPO in 2026, 2027.
Yeah.
We'll see.
Well, I do look forward to that because having been an angel investor in some of those. Wonderful. So let's jump to some of the M&A. We talked a little bit about M&A. So tell us about the trends in M&A that you're looking at.
Yeah, so we just talked a little bit about how it has taken a big hit up, which is a good thing, and we think it's going to continue. There is a perception there is less regulatory oversight right now in acquisitions. If you remember back 2022, 23, Figma as an example. Big acquisition, 20 billion. Down, right? The government didn't want that to happen. So that certainly is going to continue. It's certainly driving acquisitions. And again, more companies hitting a wall. If they can't get another round, then they're open to being acquired rather than liquidating. And reverse-acqui-hires. So this is a counter trend, I guess we'd say. Reverse-acqui-hires are a terrible thing.
We had been served.
My humble opinion. So reverse-acqui-hire, for anyone who isn't familiar with the term, is when one of these large companies, your Google, OpenAI, literally Amazon, all the big ones, rather than putting out the money to buy the company, they are paying to bring the founders over, potentially even the entire technical team over. They make all those folks happy. They pay some money for the tech to be able to distribute it, and that's it. They don't buy the company. The company is left pretty much as a shell and has to pivot, has to do something. Yeah, it's really a breaking the social contract with the rest of those employees who came onto that company with the understanding they were going to work hard and hopefully all profit as a group when a good event happened. But reverse-acqui-hires there have been at least 7 I can think of, and they have definitely done a big reduction in what we would expect to see with AI growing the way it is. Those big acquisitions never happened, right? So that's as a matter of fact, I read today Apple is in the middle of doing one of these.
Oh wow. And we saw Scale AI. We talked about that.
Scale AI is probably the worst example of all, yeah. The entire technical team, the CEO went over. There was a $49 billion investment by Meta into Scale AI, which, as I understand, went almost exclusively to the folks going over to Meta and the investors in Scale. And the Scale group, the remaining employees, are left to pivot, come up with what are they going to do next, and how are they going to, if you will, bluntly cash out. Yeah.
Yeah, I mean, I'm sure you're getting a lot of questions. Do keep them ready. We'll call out the questions in shortly. So talk about IPOs, right? We saw a bunch of IPOs, some IPOs.
This has been the first year we've seen a significant number of IPOs. There were 3 tech IPOs back in 24, Reddit, Astera, and one other I can't remember. But this year we did see some more coming out, and it's good news. These are not huge they're significant. They're significant IPOs. Note the ones shaded in red. All of those were what we call a down round IPO. So the valuation at IPO was actually less than their high valuation, probably 21, 22 time frame. But it's a good event for the company. They've eaten their down round, if you will. The employees came out with something good, the founders came out with something good, and now they're in the public market. There's no big rush to IPO right now. You know, companies are not running to the door. There's one more coming this year. I'm trying to remember who it was. Anyways, they just announced a couple days ago. That's it for 25. We'll see some more in 26, but there's no indication that there's a big rush to go to IPO at this point. You know, next slide we'll talk a little bit more about why.
But before that, I'd love to hear about, so we see that there's a lot of health areas as well as some tech. What are some future areas that are potential for IPOs based on your assessment?
AI. AI. We can say biotech, and biotech did not do real well this year in the IPO arena. Billion to one was the one that came out and did the best. It popped and it's up. But in general, the biotech and healthcare IPOs didn't have a huge pop, a huge plus. Public market right now appears to be looking for AI. We won't really have a feel on that until one of the pure AI companies goes. We see CoreWeave, which is not a Silicon Valley company, but we track what they're doing, and they're doing well out there.
Yeah.
And obviously NVIDIA, the first $1 trillion company. But no, that's AI I would expect next year to give us a better indication on where the market wants to go.
Yeah, and that might even trigger more activity, which is always good. Right?
We hope.
With that, let's talk about 2026. What do you see some of the trends coming up?
Yeah, not good for IPOs generally, and not good for liquidity, unfortunately. We see companies staying private a lot longer. There are more than 750 companies right now, worth more than 500 million each, that are private. Any of these companies could have gone public. They haven't. Why? Well, a lot of money is now available for late stage funding. This is not true many years in the past. Companies got to a Series C and they went public. Now, you see, last December, Databricks, they did a $10 billion IPO. And in part of that, they went ahead and did a secondary round for their employees. So anyone who wanted to take some cash out could do so. And the secondary market is one of those things. Good side for LPs, for investors, they're getting some liquidity through the secondary market. Good side for the employees and the founders, they can get some money out. But this is limited to the companies that have a market in the secondary, So that is reducing pressure on the companies to go public. On the good side, obviously, it's giving them some money in terms of the employees, the founders, the investor, the LP. It has brought some liquidity back to the valley. And it's interesting because a good number of the VCs now have one person dedicated to secondaries, to finding ways to bring liquidity to any of their investors that want to take advantage of it.
I can see that because especially having been part of some venture right now, without liquidity, the new LPs are not going to fund. So that is important for both VCs and for founders. And it's good, at least some employees get some value as a result of the secondaries. I think we talked about VCs and the funding, and this was a very interesting slide that you presented earlier. Tell us about this.
Yeah, this is a slide from PitchBook, but it represents many of the Valley VCs. Many of the big VCs are here in Silicon Valley. What you're looking at there is a graph that shows you how concentrated venture capital has become in the last few years. The Founders Fund at the top raised, what is that? I don't have the percentage, it's a lot. What I can tell you is that, we'll see in the next slide, if we can go to the next slide actually. So, amazing. 12 firms raised, actually I goofed that one up. Anyways, 12 firms raised 50% of the venture capital raised in the first half of 2025. And I think it is 30 of them raised 75%. First-time managers only got 6%. So now this is not, it's a fact, but it's not real good for the ecosystem from a startup's perspective. The more concentrated that capital gets, the harder it is to get funding. Because quite frankly, for a lot of startups, most startups, they're going to get their funding from the smaller firms, from the seed stage, the pre-seed, the emerging managers who focus on a tighter niche. So yeah, this was true last year. It's true this year. I suspect it'll be true when we look at the end of the year numbers. Not changing anytime soon. And that means that raising a new fund, very tough. Unless your name is someone like Jack Altman, Khosla, Andreessen, Founders Fund, yeah, well, the known names are out there, they're raising funds and they're closing.
Yeah.
Everyone else, not so much.
Yeah, I think there is this sort of abundance on one side, and then there's a real, poverty on the other side, sort of a mix happening, right? Some of them are able to raise money in a week, right? I know some really good fund managers who've raised like millions of dollars and committed in a week, versus some of them are working on it for over a year, and it's like a huge trail of, going in a wide
Absolutely
path
true.
for them.
Yeah, it's sort of like two sides of the rivers. And this is both VCs and startups, actually. There's a select group of startups who can get funding very easily.
Mhm.
There's a select group of VCs who can walk out and LPs will write checks. The rest of them, not so easy.
Yeah.
It's a tough time.
Absolutely. So, what are some advice that you would give, like some of these emerging managers? Do you have any thoughts on what they should be thinking about? Are there any investors in the audience? Okay, there's one brave investor in front. There's one in the back. He's afraid that all the founders are going to
raising a new
come.
fund?
Yeah.
Not right now.
Yeah.
Not right.
Good answer.
Good answer.
Preethy, it was interesting. The luncheon that you and I went to with the 5-star, one of the questions asked was, how many of you, and this was almost all investors, how many of you are raising new funds? And there were a lot of hands that went up.
Yes.
And I think the next question was, how long have you been, or how many of you have been raising new funds for the last 6 months? And the same hands stayed up. It's not an easy environment to raise money in.
Absolutely. Well, so hopefully some of the IPOs that we expect to see will drive some more activity. So tell us about a little bit going into 2026, what are some trends that you see continue and change?
We think that there is just going to be a slow return to liquidity. It's not going to happen quickly. It's going to take time. So we expect to see, again, the secondaries making a little bit of difference. We're hoping to see more IPOs, Anthropic, OpenAI, we'll see. But a slow return to liquidity. And part of that slow return to liquidity is secondaries continuing to grow. I saw a figure this morning, they're $8 billion now in current VC secondaries, dry powder. So that's out there looking for places to put it. And they're going to continue to, for anyone who doesn't know DPI, it's how much money have you gotten back as an investor from against what you invested originally. And if your DPI isn't 1, you're probably not going to get, as a VC, you're not going to get someone to invest with you again. So it's all about liquidity for the investors. And from an investment perspective, more AI investment. This is the focus of almost every new fund we've seen announced or in the process of raising for the last 6 months. The only exception is biotech. There are a few dedicated biotech funds we've seen. But outside of that, everything is AI.
Yeah, that's very interesting. And even the IPOs seem to be slanted that way.
I think that's going to be true too, yes.
Yeah. Well, let's open it up to the audience. Let me actually grab a mic.
Thank you so much for the wonderful conversation and the insights what's going on. One slide stood out, and that's when I was trying to wonder if there was a correlation between a few slides back where you were mentioning as such that most of the funding is, most of the investments that are being made are made by a few small venture capital firms. Like you said, 13 or 12. You were mentioning that.
That's not investments made.
Sorry, not investments.
That's funds raised.
Funds
Venture
raised.
capital raised by VCs that will later be invested into startups.
That's correct. But they're also the ones who are primarily are funding most of the new investments into the startups, because the smaller venture funds are not able to raise money from LPs to actually fund and seed the new startups as such. I was wondering if there's a correlation between the fact that the valuation that is climbing rapidly for select companies, because it's like a self-fulfilling cycle, a virtuous cycle for that, where basically it's creating a barbell kind of effect, where one side is actually heavily skewed because the funding is going there, because their funding is being going there from the firms that are actually raising money are basically one side of the spectrum, and the other side seems negligible at all. And I wonder if there's a correlation that is kind of skewing the value. And have you ever seen that happen in the last few decades? Did it happen in .com or not? And how did it self-correct?
Well, let me amplify one of your comments. As far as what's being funded right now, keep in mind that there is a tremendous amount of dry powder. Okay, dry powder, another one of those terms. Dry powder refers to VC funds that have been raised, but they haven't yet been invested. And there's a lot of dry powder out there right now. It's a number we can't get a firm feel on, but it's something between 330 billion and 500 billion. Big numbers. So all of that dry powder out there is spread among a number of firms, many of which are still investing, even though they're not raising right now.
Where are they investing?
They are actively investing. I'm sorry, Deep, you had a comment?
Can you define dry powder for the audience, and what is the timeline associated with that and why that matters?
Oh, I thought I did, I'm sorry. Again, dry powder is money that has been raised by venture capitalists. It's in funds, it's been committed. It actually may not be in funds, it's been committed and not invested. All right, so everything before 2020, most before 2020 has been invested. Most of 2021, going forward, not so much.
You have to press it once.
No? No, it's
I think it's a sign.
Okay.
I can hear you and I'll
Can you hear
repeat
me?
your
Okay.
question.
Yeah, so what happens if the VC firms don't deploy their dry capital? What happens?
In a very rare number of cases, they'll give it back. I've
Oh,
only seen that happen twice.
oh,
Most of the time, they hold on and they invest it
So it's
sooner
kinda like-
or later.
it's kind of like Santa Claus's list. Like, if you're nice, they give you money. If you're naughty, they don't give you money, and they have to give the money back. The LPs may not be very happy about getting their money back. Then will they?
I've only seen that happen twice, Steve.
So they have all this money sitting in their pocket, $500 million, $500 billion.
No, hold on. Uncommitted capital.
Uncommitted capital.
So if you were an investor in A16Z,
Yes.
you might make a commitment for $2 million.
Right.
What they're going to ask you for right now is a quarter of it.
Okay.
All right, the rest of it, they'll put a call out to you for filling that commitment when they need it. But it's still out there. You've made a commitment. As far as these numbers are concerned, there's 300 billion to 500 billion in committed capital. that hasn't been invested yet. That make sense?
Somebody has a really big pocket with a lot of money in it.
There's
Lots
a
of people.
lot of pockets out there.
Really deep pocket all the way to the shoes.
Oh, that's why my name is Deep, right? So, and the point is, all you founders are supposed to help find those VCs that have that money.
So my question,
And that's an art, deep.
so my follow-up question and your point, 350 billion to 500 billion that has been committed or actually allocated or somewhat allocated, why hasn't it been deployed?
The VCs have not decided that the companies that they're seeing, that they're looking at, are worth deploying it. They're holding it for, it could be a better economy, it could be the right company, it could be the right founder. It obviously depends on the VC as to why they make their decisions.
Do you know any trends?
So one of the things that at least, what I'm hearing from VCs is that every company they invest, they are looking at a company that can blitz scale, right, because of the power law. And so right now, from what's happening, there are only few of those companies that are seen as blitzscaling that company. So that could also be a potential factor.
Yeah, keep in mind, the VCs promise a certain return. And they're not going to invest unless they're pretty darn sure that that company, at least in theory, is going to be able to return that percentage in making the investment.
Are there any other questions from,
Yeah,
I think that you want PK,
Yeah.
then the.
Don, excellent presentation. It was
thank you, PK.
very invigorating. One of the slides that caught my attention, it's a simple slide but really amazing, was a sector-wise funding. Quite a bit of the funding went into AI infrastructure.
Yep.
Then of course the applied AI, then the fintech. I was just trying to look for where is healthcare, and I had to really go from bottom up. Are we not focusing on that sector, or why are we ignoring it so much? Is it a reflection of our common thought process?
Healthcare is the systems around providing the care, and it gets a lot of money. There's no question, but it doesn't get any place near what AI and applied AI do.
Even lesser than a medical device and diagnostic space. I have an investment in diagnostic space,
Yeah.
but it's even below that. I found it very hard to get that.
No, it's about the same. It's
yeah.
about the same.
Biotech
PK.
is more.
Biotech is more. Okay, got it. Okay,
Yeah.
that's an interesting. Healthcare is the bottom of the pyramid now.
Actually, the bottom of the pyramid is a bunch of other sectors that are all thrown together under other.
Okay.
Okay, there's just so many. Literally, you could have.
Should we be
Yeah,
happy?
20.
Should we be happy looking at this or feel sad?
And by the way, if you want to get into more detail, PK, I do a webinar on this stuff once a month.
Okay.
That happens to be the first Friday, which is tomorrow at noon. So anyone who's interested, you can do your sign up on our LinkedIn company page, Link SV, and join us.
I'll join that.
Wonderful. I think there was one question there, and then Sargam, and then we can wrap. Oh, okay.
Just to follow
Sure.
up to what he said.
Sounds good.
So if applied AI was being used in medical devices, biotech and healthcare, it's still
No. Applied AI is not any of the other sectors. Applied AI goes towards enterprise, okay, enterprise software, which is more horizontal, right?
Mhm.
And then a few verticals, and those verticals, I think insurance, a couple others, but it is not the other verticals that you see up there. On the other hand, that doesn't mean that those verticals don't use AI. They do.
Okay.
They do. It's just
but it's
different
separated.
sectors.
Thank you for the
So last
clarification.
question, actually maybe two more and we'll finish up so that we can. I think hands are coming up very slowly. Go ahead, very quick.
So what I'm noticing is that a lot of pre-seed VC, they are positioning as a pre-seed VC, but when you talk to them, they are expecting maybe like you generate 200K, 300K, or 400K. So there is a very disconnect, right? Because if you are generating 400, 500K, that means you are no longer in a pre-seed, you are already seed.
Not anymore. That's what Dawn talked about, right?
Ask again, I'm sorry, I didn't get the.
So I'm saying that a lot of the pre-seed VC, those who are positioned as a pre-seed, right? But when you actually talk to them, they are expecting founders to generate maybe like $500,000 ARR. So then it's no longer just a pre-seed, right? It's big, some founder is able to generate $500 million.
Now, those definitions are very, very flexible, let's put it that way, okay? The bulk of pre-seed funding comes from YCOM. YCOM, and this area is amazing. I'm talking about Silicon Valley. You've got YCOM, we've got Berkeley Skydeck, we've got a couple other accelerators.
Mm-hmm.
But YCOM puts so many companies into this area. Better than 65% of their companies that they graduate are local. And that's new since Gary Tan took over, but that's what they're doing. Every one of those companies gets $500,000. Therefore, you'll never see the median on pre-seed companies change from $500,000. There will be outliers, but more or less, the definition of pre-seed is what the investor and the company want to make it.
I see. Right, thanks.
Hi, first a super quick question. So all these data, are they from all the VC companies in the US, not just the Valley?
No, this is just the Valley. Well, some of this data is PitchBook. I think I called out when it was PitchBook.
Got it.
But the data we accumulate and put out on a daily basis is Valley, Northern California only.
And that's for the headquarters or the office people based in that? Sorry.
No, that's a good question. It used to be a straightforward, oh, they're in here, they're here, they're here. No, it's almost an art now trying to figure out where a company is. Remote workforce, remote pure, CEO here, rest of the company. We make a call on every single company. But every company that goes into our newsletter, goes into our database, I look at individually and make the call on, do we want to say they're here? Is their CEO here? Can they be reached here?
Yeah, that makes sense.
Yeah.
So my real question is, it looks like from your data, the VC perspective, there is a concentration, of course, right? The biggest VC, the most influential VC will get a lot more funding and maybe they get the best deal. At the same time, from the startup side, a couple of largest startup gets most of the funding. It could be infrastructure, it could be applied AI, but in some startup don't even need much funding these days. I don't know if that's your observation as well.
Oh, absolutely. A lot of those YCOM, I won't say a lot, a number of those YCOM companies never get any more funding and they're off and running. You know, $500,000 does it. Depends on the kind of company.
And then for the company that do need money, do you see a lot of concentration as well for the startups? Like in terms of how much money they're getting, for example, the huge ones like Anthropic, OpenAI, those are very huge. Do you see that trend going forward where if they compete in the same space, the best ones gets the most and then, you know, it's a very
No, not necessarily, unfortunately. It tends to be the startups that have the best connections, the CEOs know people, know how to get to where they're going. Certainly the VCs look at the company and try to make their bets on who's going to be the breakout company. But it's more nuanced than, you know, absolute best tech kind of thing.
Yep, thank you.
Thank you. Wonderful. Let's wrap up.
Could I have just one
Yes.
moment to?
Yes, I was going to ask you, right?
Thank you.
Thank you so much, Dawn. Would love to hear any final thoughts that you have for the audience here.
Get ready for a very interesting 2026. I don't think anything that you've seen here is going to change. It's going to accelerate. There's a lot of dry powder, to use that term again, out there. And if uncertainty stays low and AI keeps building, the VCs are going to invest a bunch of it. I want to give one plug for Link SV. So my company has two sides. One side is gathering all this data, putting out the newsletter. We monetize through service providers or anyone around the startups who wants to know when companies get money. We're the first ones out with that information. On the other side, we work with a lot of startups. We give startups the information you've seen here that costs service providers $50 a month. Startups get it for $7 a month. We also work with startups, have a lot of resources on our website, help to connect you with trusted outsourced developers and selected HR resources. So go to our website, feel free to ping me, I'm up on LinkedIn, dawn@linksv.com. And I really appreciate everyone being here today, and I so much appreciate Preethy and Deep for putting this together and inviting me. Thank you, Preethy.
Thank you, Dawn. Let's give a big round of applause.